The price you see on your screen right now for silver is not the real price. Not entirely. What you're looking at is a paper number, a figure derived from contracts, derivatives, and digital promises. And somewhere beneath all of that, there is a physical market telling a completely different story. If you own silver, plan to buy silver, or simply want to understand where commodity markets are actually headed, what you are about to hear in the next few minutes could permanently change how you read a price quote. So in this video, we're going to separate what's real from what's just hype. By the end, you'll walk away feeling calmer, clearer, and far more confident about what you're actually buying, and more importantly, why you're buying it. Drop a comment below and let me know the exact day and date you're watching this from. I love seeing where and when you're tuning in. And real quick, if you appreciate content that's built from scratch, thoughtfully researched, and never copied, support the channel by subscribing and commenting Henry's Market HQ below. It helps this channel grow more than you think, and I truly appreciate it. Most people who buy silver think they understand the market. They check the spot price, they maybe glance at SLV, the largest silver ETF on the market, and they feel informed. They feel like they know what silver is worth. But here is where that assumption quietly starts to fall apart, and it is falling apart in a way that the financial media is almost entirely ignoring. On a single trading session, 3 different instruments tracking the exact same metal, silver printed 3 completely different numbers. Silver spot came in at $84.11, printing green and moving higher. SLV, which is supposed to track silver, printed red at $76.16. COMEX silver futures, printed red at $83.77. 3 screens, 3 signals, 1 metal, 1 minute. That kind of divergence does not happen in a healthy, well-functioning market. That is a symptom of something deeper, and if you have money in any silver-related instrument, you need to understand what is actually causing it. To understand the divergence, you have to understand the architecture of the silver market itself, because it was not built the way most retail investors assume. The spot price, the number everyone watches, is largely derived from futures activity on the COMEX exchange, which is part of the CME group. COMEX is where large institutional players, mining companies, banks, and hedge funds trade silver contracts. These contracts represent agreements to buy or sell a specific quantity of silver at a specific price on a future date. The vast majority of these contracts are never settled with actual physical silver. They are cash settled or rolled forward before delivery ever becomes a reality. That means the price you see quoted as the silver price is in large part shaped by a market that is trading paper claims on silver, not silver itself. The physical metal and the paper market have been allowed to diverge for decades, and for decades that divergence stayed manageable. What is happening right now suggests the gap is widening in ways the system was not designed to absorb quietly. The CME publishes a daily warehouse report, a vault-by-vault breakdown of how much silver is sitting in COMEX-approved depositories. There are 2 categories that matter: registered silver and eligible silver. Registered silver is metal that has been specifically set aside and approved for delivery against a futures contract. Eligible silver is metal stored in approved vaults but not currently designated for futures delivery. It can become registered, but it has not been committed yet. As of the most recent report, total COMEX silver inventory stood at approximately 344 million ounces. Of that, only 78.6 million ounces were registered. That means less than 23% of all the silver sitting in COMEX vaults is actually deliverable against the contracts being traded. More than 3/4 of the metal those contracts are theoretically backed by cannot be called upon for delivery without additional steps and agreements. And on a single day, over 1 million ounces of eligible silver walked out of one vault, one depository, while registered inventory quietly grew at a different location. The net result was a reduction of 216,977 ounces across the entire COMEX silver complex. Silver is leaving the system faster than it is being replaced, and that is not a data point you want to skim past. The DXY, the US dollar index, was trading at 100.025 and printing green on the same session where both gold and silver were also moving higher. Under normal market logic, a stronger dollar and rising precious metals prices are supposed to work against each other. Dollar strengthens, commodities priced in dollars get more expensive for foreign buyers, demand softens, prices fall. That is the textbook relationship. When that relationship breaks down, when gold, silver, and the dollar all climb together, it signals that safe haven buying is overriding currency dynamics. It means institutional money is not moving into precious metals because the dollar is weak. It is moving into precious metals because something else, something more structural, more concerning, is driving the demand. And that kind of demand does not reverse overnight. The retail side of this picture adds yet another layer. Data from the session showed retail investors net selling silver exposure, yet the metal was bid higher. When ordinary investors are reducing their positions and the price still rises, it tells you that larger, more sophisticated money is absorbing that selling pressure and continuing to push price upward. That is not the behavior of a speculative rally. That is the behavior of a positioning shift, a slow, deliberate accumulation by players who understand exactly what the warehouse reports are saying and are acting on it before the broader market catches up. If this is making sense so far, go ahead and hit that like button. It genuinely helps this channel reach more people just like you. And this is where most people stop reading, stop watching, stop paying attention, but the ones who stay are about to understand something that could completely change how they see their money. The bearish case for silver exists, and it deserves a fair hearing. Dismissing it would be intellectually dishonest, and you deserve better than a one-sided narrative. So let's walk through it with the same rigor. The bear case rests on a few legitimate concerns. First, industrial demand for silver, while historically robust, is sensitive to global economic slowdowns. Silver is not just a monetary metal. Roughly half of annual silver demand comes from industrial applications, solar panels, electronics, medical equipment, electric vehicles. If global manufacturing contracts, that industrial demand floor can soften. Second, if the Federal Reserve signals a return to tighter monetary policy, or if risk appetite in broader markets collapses, investors who moved into precious metals as a hedge may rotate out, creating selling pressure that pushes prices lower despite supply concerns. Third, a sharp rally in the dollar, not the mild green session we saw at 100.025, but a genuine dollar strengthening cycle could suppress silver prices in nominal terms, even if physical demand remains firm. These are real risks. Anyone managing serious money in the silver space has to hold them honestly. The mistake is letting those risks become the only lens through which you see the market, because the counter-argument, the physical supply argument, is not speculative. It is documented, it is measurable, and it is published every single day in the CME warehouse report that almost no retail investor ever reads. Here is the counterintuitive truth that most silver commentary misses entirely. The paper market and the physical market do not have to agree until they do. For years, the gap between paper silver prices and the true cost of acquiring physical silver in size has been dismissed as a technicality, a curiosity, something only hardcore gold bugs worried about. But that gap has a breaking point. When the number of paper claims outstanding on silver grows large enough relative to the actual registered inventory available for delivery, the market faces what analysts call a delivery squeeze. A delivery squeeze happens when enough contract holders simultaneously demand physical delivery, and the registered inventory cannot satisfy those demands without emergency procurement of eligible metal, buying from the open market, or in extreme cases, a cash settlement at prices significantly above the paper quote. The registered inventory, sitting at less than 23% of total COMEX holdings, is not a comfortable buffer. It is a thin margin operating under a system that was designed for a world where almost nobody ever actually asked for the metal. What makes the current setup particularly worth watching is the eligible to registered movement happening beneath the surface. When large quantities of eligible silver move out of vaults, as over 1 million ounces did in a single session from a single depository, it raises a legitimate question: where is that metal going? It could be moving to industrial users taking direct delivery. It could be moving to private buyers accumulating outside the COMEX system. It could be moving internationally to markets where physical demand is more aggressive, particularly in Asia, where retail and institutional silver buying has been structurally higher. None of these destinations return that metal to the COMEX system automatically. Once eligible silver exits the vault network, the registered pool does not replenish itself unless new metal is deposited and designated, a process that requires time, logistics, and seller willingness at current prices. The SLV divergence deserves specific attention because millions of retail investors hold SLV as their silver position and believe it to be a clean direct proxy for silver prices. On the session in question, spot silver was up sharply, and SLV was trading at a meaningful discount, $76.16 versus spot at $84.11. That spread is not just a rounding error, it reflects real friction inside the ETF structure. SLV operates by holding physical silver bars in custodial vaults, primarily through HSBC. When the ETF trades at a discount to spot, it typically means either creation basket mechanics are constrained, redemption pressure is elevated, or the market is pricing in some uncertainty about the ETF's ability to acquire metal at spot prices. For the average investor watching SLV as a silver tracker, a divergence of that magnitude on a green day for spot silver should prompt serious questions about what they actually own and how faithfully it tracks the physical price when it matters most. The futures market printing red at $83.77, while spot printed green at $84.11, is a contango to backwardation signal worth monitoring. When near-term spot prices exceed futures prices, it is called backwardation, and in commodity markets, backwardation is historically associated with tight physical supply. The market is essentially saying that the metal available right now commands a premium over the metal available later, which only makes sense if acquiring physical silver today is genuinely more difficult or more expensive than acquiring it in the future. Sustained backwardation in silver would be one of the clearest signals the physical market is beginning to exert pricing power over the paper market, rather than the other way around. So where does all of this leave you, the person watching this video, trying to make a smart, grounded decision about precious metals in a market that is sending contradictory signals from every direction? It leaves you better equipped than you were 20 minutes ago, and that is exactly the point. The answer is not to panic, and it is not to ignore what the data is showing. The answer is to be deliberate, to think in layers, and to make decisions based on what is actually happening in the physical supply chain, not just what a price ticker is telling you. The first thing to understand is the difference between what you own and what you think you own. If your silver exposure is entirely through paper instruments, ETFs, futures, silver mining stocks, you have exposure to silver's price movements, but you do not have silver. That distinction is irrelevant in most market conditions and becomes critically relevant in stress conditions. Deciding what percentage of your precious metals allocation should be in physical form versus paper form is a personal risk management question, not a market timing question. It should be answered based on your own financial situation, your time horizon, and your honest assessment of why you hold silver in the first place. The second thing to do is read the CME Warehouse Report regularly. It is free, it is published daily, it takes about 3 minutes to read the key numbers: total registered, total eligible, net change, and vault-by-vault movement. Most retail investors have never looked at it once. The investors who track it consistently are operating with a layer of information that simply does not show up in price charts or financial news headlines. The pattern of eligible silver leaving vaults, the pace of registered inventory change, and the ratio of registered to total holdings are all leading indicators that deserve attention, well before they show up in price action. The third takeaway is to treat the spot ETF futures divergence as a monitoring signal, not a trading signal. When these three instruments are telling meaningfully different stories about the same metal on the same day, it is a sign that the system is under some form of stress. That stress does not automatically resolve in a specific direction or on a specific timeline, but it does tell you that the silver market is not operating in calm, consensus-driven conditions. It tells you to pay closer attention, to tighten your analytical framework, and to think carefully before making large directional bets based on any single data point. I want to be clear, I'm not here to sell you anything. I'm here because this information changed the way I think about money, and I want it to do the same for you. The silver market is one of the most misunderstood corners of global finance, and the gap between what the paper market is pricing and what the physical market is experiencing is the variable that institutional players are watching most closely right now. That gap will not stay invisible forever. Markets have a way of forcing reconciliation between paper claims and physical reality, and when that reconciliation happens, it tends to happen faster and more violently than anyone predicted. What you can do today is simply understand what you own. Track the data that matters, and refuse to let the noise of daily price movements substitute for genuine structural awareness. Silver is not just a trade. For millions of people globally, it is a long-term store of value, a hedge against currency debasement, and an industrial input whose demand is growing faster than new mine supply can replace it. The fundamentals have not changed. The paper market's ability to suppress those fundamentals indefinitely, however, is a question that the warehouse reports are beginning to answer in real time. Watch the registered inventory, watch the vault flows, watch the divergence between spot, ETF, and futures, and watch what happens when the 23% becomes 20%, then 15%, then less. That number is the one nobody is watching closely enough, and now you are. If you are benefiting from our topics, please subscribe, like, and turn on the bell notification so you can see our new videos early.